Did you know there are now 48 private equity backed platforms actively rolling up CPA and accounting firms across the US? And that now 30% of the top 75 accounting firms in America are now backed by private equity. Hey everyone, I'm Oliver Bogner, managing partner of the Advisory Investment Bank. If you own a CPA firm, an accounting practice, any sort of specialty financial services advisory shop, the next 10 minutes may fundamentally reshape how you think about your industry. Did you know there are now 48 private equity backed platforms actively rolling up CPA and accounting firms across the US? And that now 30% of the top 75 accounting firms in America are now backed by private equity. Hey everyone, I'm Oliver Bogner, managing partner of the Advisory Investment Bank. If you own a CPA firm, an accounting practice, any sort of specialty financial services advisory shop, the next 10 minutes may fundamentally reshape how you think about your industry, because right now the accounting sector is experiencing the fastest and most aggressive consolidation cycle in the history of the sector. So here are the numbers that most partners don't see. 48 private equity backed platforms actively rolling up CPA and accounting firms in the US. 30% of the top 75 accounting firms are now backed by private equity. This is no longer a theory. This is the new reality of professional services. So today I'm breaking down what's driving the M&A wave, how these roll-ups actually work, what firms are worth, what owners need to understand before exploring a merger, recap, sale. Let's get into it right now. So part one, why is private equity flooding into accounting? So accounting used to be slow, stable, relatively very quiet sector. Not anymore. For the last 5 years, private equity discovered that CPA firms have exactly the characteristics that they love about essential services. One, recurring revenue. Audit contracts, tax engagements, monthly bookkeeping, payroll, advisory retainers. This is subscription-like cash flow. These are number two, mission critical services. Clients must file taxes. They must complete audits. They must manage compliance. Number three, high retention and long client relationships. Multi-year contracts with decades-long client loyalty. We've been covering accounting for the last year. Some of these retention rates are through the roof. We see 99 to 100% retention rates when you're looking back over a 5 to 10 year period. That's insane, and it's why private equity is obsessed with accounting. Number four, fragmentation. Tens of thousands of small and mid-sized firms. This has created a perfect environment for roll-ups. So perfect group for private equity is typically a tier 1 or tier 2 market, 2 or 3 partners, maybe 5 or 10 partners that are of retirement age, looking for that next opportunity. Certain partners are retiring and want to get out. This is why private equity loves it. And then number 5, massive unmet demand. The CPA talent shortage is very real, and PE sees that as an opportunity in scaling labor through supply, shared recruiting, some outsourcing models. This is why 48 platforms now exist, and we see new ones coming into the market every single quarter. Part two, what buyers actually value in accounting firms. So buyers evaluate CPA firms a bit differently than traditional Main Street businesses. So here's what actually impacts valuation. Number one, service line mix. Firms with audit, tax, CAS, client accounting services, advisory, wealth, outsourced CFO are valued higher. But pure play, folks that just do tax and advisory can still sell for a premium multiple. But client accounting services with advisory equals the strongest multiple. So two, contracted recurring revenue. Multi-year contracts, subscription, that's the plan. You got to have those multi-year contracts with the client. It's an auto renewal, some sort of engagement letter where it just continues to renew every single year. Number three, if 1 or 2 clients make up over 10%, obviously valuation dips. We haven't seen that with most of our CPA clients. Very little client concentration. Number 4, technology stack. This is a big thing. Make sure that your firm is on the latest and greatest technology. Standardized software really increases efficiency and the integration value. And then number 5, and we do see this across our amazing baby boomer, silver tsunami clients, the book of business is typically tied to a partner's personal relationship. So we understand that. We just really want to make sure that there's at least a couple other CPAs in the practice that also have relationships with the client. Very rarely do we see these deals work where the partner can just leave. Typically, it's a 3 to 5 year kind of exit path to leaving. So again, continue to make sure that there's a second layer of management and of trusted talent that can also engage with those clients. And then number 6, talent pipeline. Do you have strong staff? The better the staff, the better the valuation. If it's 1 or 2 CPAs doing all the work, it's a little tougher. Everything's still sellable when it comes to a CPA practice. A lot of the PE consolidators are buying good quality books of business. But again, these are things that come into mind that really do impact valuation. Number 3, today's realistic CPA firm valuation multiples. So today I'm going to talk numbers because most firms have no idea what the market is really worth. We know that historically you might go to a friendly, quasi-competitor and say, let's merge when you want to retire. But today, we're seeing small firms below $1 million of EBITDA still be sellable. Those sub-$1 million EBITDA firms are trading for between 4 to 5x. When you're between 1 to 3 million of EBITDA, that's where we're seeing firms trade for between 6 to 8x. And of course, the larger firms are between 3 to 10 million of EBITDA. Those are going for between 8 to 10x. And then the platform size firms between 10 plus million of EBITDA are going for 10 to 14x. So really, really strong multiples. There's 48 platforms. Creating competitive tension, creating a very competitive process is what increases the value. It's why we exist. It's why the process matters. We have seen that when a buyer is reaching out directly to a local market CPA firm, they're typically offering between 20 to 40% below market. It's why the process matters so much. Part 4, how rollups work in the accounting industry. So rollups are not a new thing. But CPAs are now at the center of one of the biggest professional roll-up services cycles we've ever seen. So here's how it works. Typically, phase 1, PE firm acquires a platform firm, usually at least 10 of EBITDA. This becomes the core brand, management structure, back office. Phase 2, we then do the add-on acquisition. So they're going to buy these smaller firms to expand geography, talent, service lines, industry verticals, maybe offshore capabilities. And that's where they really make kind of paper value, right? So if they have acquired a bigger firm, let's say $10 million of EBITDA, they've acquired that for, let's say, 10 to 12x, they're buying the $1 or $2 million EBITDA firm for 6, 7, 8x. And that's really where there's value creation being done day one. Part 3, it's all about integration. This includes centralizing admin, back office, HR, recruiting, updated tech stack, improving billing, standardizing the advisory offerings, building the offshore labor leverage. Some platforms get very, very aggressive with integration day one, and others let the group just run total partner autonomy. So again, choosing the right cultural fit matters more than the price, because phase 4 is all about that secondary exit, that second bite of the apple. So after 4 to 7 years, typically the entire platform sells again. So partners that have rolled equity are going to actually make more on that second bite, sometimes more than they do on the first bite, because the valuation's gone off, the EBITDA arbitrage becomes real, and everyone's typically looking, at least private equity is looking for a minimum of 2x their capital. A lot of the time they're aiming for 3, 4, 5x, and you get that same second bite of the apple that the PE firm does. So part 5, deal structure and how CPA firms actually get paid. So major misconception. A $10 million sales price means you get $10 million paid immediately. Not true. Deals include cash at close. Typically with CPA firms, we are seeing lower cash at close. Typically it's between 50 to 60% that's cash at close, which is immediate liquidity. Then there's equity rollover. Typically that's between 10 to 40% of the stake, and that really is your stake in the future value. And then there also is an earnout component. We always are seeing an earnout component when it comes to CPA firms, especially when it's tied to a single partner. So often tied to revenue retention and margin targets. More than likely we're seeing it just tied to revenue retention. And then 4, partner comp restructuring. So usually a mix of salary, bonus, participation in the platform upside. And then 5, retirement succession planning. So again, many platforms specialize today in buying out retiring partners while giving younger partners equity options, which is why the structure really matters here. So figuring out, are you going to be around for 3 years, 4 years, 5 years? They always ask for 5 years, but many are willing to do 3-year deals. Part 6, the biggest mistakes we see firm owners make. So here are those strategic errors that we're seeing cost business owners millions and millions through the process. So number 1, selling without competitive tension. Never take the first offer. I repeat, never take the first offer. If a buyer reaches out to you directly, take a beat, engage with a third-party intermediary like us, plug in the advisory here. Let us actually run a process, talk to the market. There's so many buyers rolling up your sector. You really want to understand what you're worth. You want to meet the market. Part 2, not understanding those valuation drivers. So again, audit, tax, all that needs to be uniform and needs to be cross-selling efficiently. Number 3, understanding integration requirements. Part of the integration is utilizing overseas talent, is putting you on the same software. So really understanding that. Part 4, taking too little rollover equity, right? So some CPAs that are retiring, they're like, I don't want the rollover equity. Rollover equity is truly an opportunity to get 2 to 3 times what your initial cash is on that second exit. And not planning that succession, right? So buyers are going to ask, who's replacing you? You really, really need to have an answer. Then my last one, using a generalist advisor or a business broker that doesn't understand what's happening with PE-backed CPA consolidation. This is a very specialized market. There's a very specific buyer pool. They have very specific KPIs that they want to see outlined in the SIM. Accounting M&A requires accounting-specific expertise. This is why it is one of our core 4 segments at the advisory. This is one of the 4 verticals that we focus. We're taking accounting deals out every single week. It's one of our core 4. It's a key industry for us. It's why we are one of the very few, I think we might be the only M&A firm that's actually partnered with Intuit QuickBooks. We're really, really involved in the sector. We're really involved in the community. We know all the buyers. We know how to run a process, and we know how to get our owners the very best price. So part 7, what should firm owners do right now? So if you own a CPA practice and you're considering selling in 1 to 5 years, here's the final part of my playbook, right? Increase multiple service lines, right? Get multiple service lines going, get cross-selling your clients. I always say, have that once a year meeting, in person, video chat with your clients. Talk about what's happening in their business. What are other things they need help with? Do they need bookkeeping? Do they need payroll? What else can you really assist them with? Cross-sell them on additional service lines. 2, really invest in tech modernization, automation, latest software, cloud systems. All of that's helping with valuation. 3, please strengthen your talent bench. If you've got really good staff behind you, it's going to pay when you go to market, right? Really important to have a strong bench of talent. 4, same thing, reduce partner dependency. You've got to shift those client relationships deeper into your team. Have other folks beyond the owner be that day-to-day client relationship. Number 5, understand the valuation early. This is going to help you know whether you sell, you grow, whatever you want to do. We are here to help give you advice, but again, really understand the valuation. We can give you a very concrete, within spitting distance of what we believe your firm's going to trade for. And if you want to run a process, we're here to help you. So again, I'm Oliver Bogner, managing partner of the Advisory Investment Bank. 48 PE platforms, 30% of the top 75 U.S. accounting firms now owned by private equity. The consolidation wave is alive and well. If you'd like a confidential valuation, breakdown of who your buyer is, better understanding of the market, we're here to help. Reach out, send us a DM, shoot us a message, visit our website, theadvisoryib.com. Looking forward to getting to know you and helping talk about your business and educate you on what's happening in the industry. Thanks for watching.